Hi, David Bassanese here, Chief Economist at BetaShares. This is a snapshot of my market trends report for the month of June. The first half of the year has concluded on a solid footing for global equities. I guess the theme is that bond yields globally were up for the second month in a row as resilient economic growth and sticky core inflation had central banks talking about a few more rate rises to come, which had to get priced into the market, and bond yields rose accordingly. Now, in May, that helped to set equities back, but equities took them in their stride, took that increase in interest rates in their stride over June. And we saw the MSCI global benchmark, equity benchmark, rising 5.4%. Strong gains in the United States, strong gains in Japan as well. They were particularly two strong countries through the month. Looking across sectors, it was really those consumer cyclical type areas that did pretty well. Consumer discretionary did well, industrials did well, technology did okay. And in terms of growth versus value, we saw both value and growth parts of the global market doing okay, both sectors up around 5.5%. So again, the theme of June has been that more rate rises are to come, at least a few more. Bond yields have backed up, but equities are taking it in their stride because I guess investors in the equity market are growing more confident that the rate rises that we're seeing don't seem like they're going to push the global economy into recession. That's the good news. The bad news, of course, is that equity valuations are looking pretty stretched. The US price to earnings ratio now for the S&P 500 is up over 19 times earnings. Still expecting a nice bounce back in corporate earnings in 24, and still pricing in rate cuts over 2024, even though the US Federal Reserve is saying that they're not inclined to cut interest rates. All this can hold together. Equities can continue going higher. Bond yields can go sideways to down, provided global inflation continues to drop quite significantly. And particularly what we need to see is core inflation drop, which probably does mean that the labour markets globally need to soften and wages growth come down. So that is the challenge, getting core inflation down globally without needing a substantial slowdown in economic growth. I mean, that's the only way you can sort of resolve the differences in the bond and equity market at the moment. I'm still a bit cautious about the outlook. I do think we need to see a period of below trend economic growth, rising unemployment, maybe not a full-blown recession, but at least a period of slower growth, weaker growth than the equity markets are sort of counting on at the moment. So that's pretty much it for now. Thanks for watching, and I'll see you again next month. And certainly if you'd like to see full details of my report looking at various asset class and returns within the equity market, please visit the insights section of our website.